Welcome to PlanStrongerTV. I'm your host, David Holland. Have you ever wondered how insurance companies do what they do? Do you understand how they can charge a relatively small premium, yet accept a large risk of loss? On today's program, I'm joined by Dan Slater, an insurance actuary who will help us understand why insurance companies are vital to our financial system. I'll also answer your viewer questions. Let's roll. Welcome back to the program. I'm very pleased to be joined again by a returning guest, Mr. Dan Slater. Dan.
David, how are you today?
Good to see you.
Thank you.
So we've had Dan on the program a couple of times to talk about shifting risk to insurance companies. And Dan comes to us with experience as an actuary.
Yes.
How many years now?
10.
Wow.
Well, 10 at insurance companies. I guess it's been 15 years total.
Okay, so you have 5 years of recovery.
Yes,
okay.
yeah, right.
All right. And Dan has a company called Core Income Advisors, and you work with insurance agents and advisors all over the country.
Yes, nationwide, really helping them kind of understand insurance, more from a technical standpoint, but also helping them select some of the different choices that you have out there, what products, what companies amongst the thousands of options you see out there in the marketplace.
Excellent. Well, I invited Dan to come back on the program and talk with us today about insurance companies and insurance agents, both of which he's had a lot of experience with. So I wanted to dig into this. You know, we've talked about why we work with insurance companies. We want to transfer risk.
Right.
Well, when you transfer risk, be it an annuity to help with how long you're going to live and where you're going to get your money, or you buy a long-term care policy because you want to make sure you're going to have the resources to pay for long-term care, or whatever type of financial or other product you might get from an insurance company, when you're transferring risk, that only works when the person who's accepting the risk is going to be able to deliver on what they say they're going to do with helping you with the risk.
Right, it's a mutual contract with you and the insurance company,
but we
and
need
vice
them to
versa.
Hold up their end of the bargain.
Correct. Yep.
So if that's the framing of the question, I guess, is what I'm trying to do, when the consumer, the person watching this program, the person who's going to buy a policy, be it an annuity, long-term care, or whatever it is, what should they be thinking about? What should they be looking for in terms of an insurance company? We want to take advantage of your knowledge and experience working for insurance companies, Dan, and I know you look at them every day. What should we be thinking about? What should we be looking at?
Sure. I'll start with the fact that it shouldn't be who has the coolest commercials.
Okay. All right. Write that down. That's good.
Yes, definitely.
All right.
In its simplest form, it's what is their financial strength, their financial health, much like you would consider yourself. You know, how healthy are you to be able to meet those obligations? There's a variety of ways that you can do that, and obviously working with an advisor, they can help get that information, because you know that's a lot of digging into a lot of the options you have and making sure, again, the stuff you see and read out there is an accurate projection or portrayal of what that insurance company can do for you.
Okay, that's good. I think that that's something that is often overlooked. You know, maybe people don't just rely on the TV commercial, but maybe they look at what is being presented to them. Maybe they just, for lack of a better way of putting it, they just simply accept what is offered. Right. And they assume that, you know, all insurance companies are kind of the same, just like all financial people or advisors are all the same. Find one you like.
Right.
You like the way the company sounds, or you know,
the one that was presented to you. It seems reasonable. There's a lot of different ways and metrics you can do that. I mean, most common is they tend to have ratings. Insurance companies have ratings. You know, kind of think of it as your grades back in grade school. But there's you know, A, B, so on and so forth. So the higher rating you have, you know, those agencies have looked at the financial health, both the assets and the liabilities
of the insurance company,
of that insurance company, and what's their continued ability to meet those future promises.
And those promises are the risks that you have transferred to them by virtue of this contract for which you are paying.
Right.
As a consumer, I'm giving you money. You now are going to do something for me at some point in the future, or maybe now.
Right. And insurance companies can do that in a way where an individual can't take that risk.
Why is that? That's an important question.
Right. So it all comes down to that concept of pooling of risk. You know, when they have 10,000 people that all have that same concern of outliving my money, right? They have the ability, and this is what the math that the actuaries do, can put it together and say, you know, a certain number of people will live 5, 10 years, 20 years, 30 years. So, you know, they can take the risk of those people living long because you entered into that pool agreement for those that, you know, may not live as long. They're able to kind of blend those risks together and kind of make sure everybody has that financial peace of mind. So that's why it's important when they run those numbers that they're running them correctly, and that's why there's these third-party agencies. And some of them look at them differently. You know, they don't, you know, some of them have different metrics or math that they're gonna use to do that. So there are even some call it aggregation of those agencies. You know, it's called Comdex rating that allows you to look at multiple agencies.
Not just look at one.
Not just one, right.
Get an average.
Yeah, it's like an average,
Are you an A student or a B student?
You
know, if you got an A in this one class and a C in another, you're a B. And I guess really the question that is important for the viewers to know is, do the ratings matter? Because, you know, if you don't have a good rating as an insurance company, or you're an advisor or agent recommending a company that doesn't have a high rating, it wouldn't surprise me that they say, well, those ratings don't really matter.
Right.
But they do, don't they?
But they do. And I say they matter both ways. Because, you know, you're looking at, you know, let's just take generally what we like to prefer. Again, we have all the insurance companies available to be able to offer products. We prefer something with an A rating.
Sure.
You know, maybe it's A minus, but you go beyond that start to say there's some, not questions, but it's just not as healthy. You know, you kind of think of it as like your own health. You know, there's certain ways in which you want to be healthy, and that's how you can judge that. So A rating is usually a good number that you have. To the same, I also say you don't want to have too conservative of an insurance company you're working with. Because really what that's doing is it's a cost to you. That, you know, is there a difference when you start, like you said, you're 97 student, you're 98 student, you know, there's some people really focus on that, but we know that you're all very smart at that point. So, so to some degree, that little bit of extra rating is going to cost you because they're having to hold more money to say they're more safe.
And they can't give you as much benefit, or your premium might be more if they were just willing to take a little bit more chance and not quite be so stodgy.
Right, yeah, because, you know, to some degree, an insurance company, they do take risk. It's not as though they eliminate all of it, but they're able to take that and manage it.
And they pool it.
And they pool it, yep. So, you know, I always kind of take that in both directions. But yeah, I mean, you do see some smaller insurance companies. I think the size of the company is also very important. That tends to lean its side towards the actual rating number, but how long have they been in business? How long have they been selling that product line? You know, you see even some of the big major insurance companies, maybe they haven't done annuities, and all of a sudden last year they're now in the annuity market. Well,
and they're saying that they've been around for 100 years, but well, they've only been doing that one product for 2 years.
Right. When it comes all down to these pooling concepts and these statistics, you have to rely upon your statistics. So what experience have you had in the past, you know, to be able to make sure that you can meet those obligations?
And the pooling is very important. You know, if you're trying to make sure that you don't run out of money, like with an annuity, and you say, okay, insurance company, I'm gonna give you some of the money I have, you give me a guarantee of income. The insurance company's betting that you're gonna live kind of a certain number of years, but if you don't, that's okay, because there's gonna be other people that die early if you die late. They make their money on the averages,
The average, right. So they don't have that concern about an individual person.
And actuaries are part of that process, right? Actuaries are the ones who study all of this data, and they say, okay, here's how long we think the average person's going to live, so we can price or come up with the numbers we're going to work with for the product.
Right. Yeah. So, and you know, and now you have all the fancy calculators and computers that kind of help with that. So a lot of that is now transformed more into how do I assess the risk if something goes wrong. And I think that's the unique part that we've brought from our firm to advisors is not just saying, here's the risk, but here's the potential risks to that risk.
Right, right.
You know, what do you have if, you know, in insurance policies? You know, it's very important, you know, it might be a lot of reading, but, you know, to understand contractually, because it is a contract, it's a piece of paper you're trading, what provisions are in there that allow you to make changes, but is there any provisions that allow them to make changes?
Right.
You know, things like premiums on your homeowner's insurance, you know, or your car, that tends to go from year to year. Things like annuities or life insurance may be more permanent, so there's things that can't change. And I think that's very important to note when you're working with an advisor, that they understand and they can explain to you what can change and what can't change.
In plain English.
Right, in plain English.
Because this is another language. I call it Finglish. You
Yes.
know, when you're reading a prospectus or you're reading an insurance company annuity, long-term care, life insurance policy, the words, it's really like another language. And you need to have some translation.
Yeah, you know, and that's what makes it different than your standard investment, because you are actually transferring a risk. You know, in most investments, you retain your risk. Market goes up or market goes down. In insurance, that's why it's so contractual, because you have to define the specifics of what they will pay you on, and you know what parts don't they pay you on. And
all that matters because the insurance company is signing up for what could be a significant liability for them.
Right.
And again, you might be the one person who lives to 120.
Right.
And they say, well, it's okay, because we know that there's going to be a person who, you know, generally they might live to 80, but they only live to 60.
Right.
And it kind of balances out.
Right, and well, that's why it's so important, and not only third-party rating agencies, but regulators. So you have state regulators and federal regulators that come together, and this is kind of a different group of actuaries, but they're the actuaries that tell the insurance company actuaries what assumptions can they use.
Right.
You know, because if like in an annuity, you're going to give them a bunch of money. Well, how are they going to invest that money to make sure 20, 30 years from now that money's there? So they can't just go do what they want. There's a bunch of prescribed, you know, much like a doctor or something like that. You have prescribed things that you can abide by, and that's being dictated by a third party like a regulator.
Because there are rules, and that is a state-specific rules for how the insurance companies can operate in their particular state.
Yep, correct. Yep, and it varies, especially as you have some newer products come out, you know, something that you have to prescribe some new thought processes to. So there's a bunch of actual actuarial groups that come together, both industry actuaries, but also from the regulator side to kind of brainstorm and say, this is the way we believe you should manage that risk.
It's a very competitive world.
Yes.
You know, insurance companies compete all the time. You know, we hear about that, and again, commercials and things like that, where they compete and we win. Well, they compete, but they all are playing with basically the same set of rules.
Yeah.
If you see somebody though that's really way outside everybody else's, you know, they're offering double the benefits for half the price.
Right.
That's a question mark.
Yeah, the old too good to be true story, right? I mean, you got to stop and step back, and I think that's also important in who you're working with as an advisor.
True.
Because you know, not every advisor is an independent advisor. They may only be representing one company.
Right.
So but we know who's the answer going to be when you want to sell a policy or buy a policy.
Right.
So having access both from the industry standpoint, but at the advisor standpoint, I think from a client or a consumer standpoint, that gives you kind of two layers of this vetting process. And that's obviously how we work with your firm is, you know, we dive really deep. You know, we're actuaries. We understand the contracts and make sure that there's not the pothole down the road that, you know, you run into, and, you know, that you're offering your clients the best thing available.
That's very good, Dan. It's a reasonable expectation, isn't it, that the consumer should view an advisor as being their advocate and working for them and finding what's best for them?
Yeah, you know, it seems very straightforward and kind of like what other discussion we would have. But, you know, like I said, you have TV commercials and you have different medias and, you know, just the old history of insurance. You had mutual companies versus stock companies. And like you said, so many people have different vested interests. It doesn't always mean, you know, the client's need is first. You know, I wish that was always the case, and that we obviously advocate for that in the way we put our due diligence. And I know that's the whole basis of your firm to make sure that's the case, because again, you got to make informed decisions and you got to know what's available.
You do, and you know, there are a lot of wonderful companies out there, and you know most of them, Dan, but I've never found one company that can serve all of a client's needs or all of the needs for all clients.
Yeah.
And a lot of times we want to diversify. Imagine that, right?
Right.
We want to use multiple companies for one client. I don't want all their eggs in one basket.
Right, and that's not even just within insurance, now you have insurance companies that have investment arms.
Exactly.
And things like that, and not saying those models are wrong, I just believe that when you have the ability to select, think of, I don't know, the buffet, you can always go get what is important to you, not what's important to them. You have the ability to make those choices to fit your plan, and as an advisor, a fiduciary, you're walking hand in hand making those selections with your
Well,
client.
and to use your analogy, if I go into the quick convenience store and they've got that one hot dog that's rotating, and that's my choice, guess what I'm going to get if I'm hungry?
Yeah.
I mean, so I like your analogy of kind of the buffet where you can look for what's going to fit for your particular situation and then assemble those things on your plate and get what's going to work for your particular situation, which can be different from the next person. But, there's no one perfect, simple one solution for everything. And I think that's really true for insurance companies.
Right, yeah, and especially like you said, those things to always consider, how does it sound? Explain to me how this is actually going to work. I always talk about, how is this going to evolve if I'm transferring a risk, what does it look like when that risk develops?
Good point.
Because most people just think of it, I buy this today, I throw it in the binder, and sometimes we'll pull it out, but I want to know exactly how will it play out. If this event occurs, what are the steps that happen? How do we engage with the insurance company to make sure we get our money back? And is my advisor going to be there to help me do that too? Or am I doing this on my own?
That's great. Good point. Well, we'll definitely have to have you back to talk about more of these issues, Dan. I appreciate your coming and being with us and spending some time and coming into Daytona and talking about it with us.
Appreciate it. It always goes so fast. So.
I know it does. Well, thank you very much. Dan Slater, ladies and gentlemen.
Thank you.
All right. Okay, it's time for the viewer question segment of the show. Today's question comes from Janet in Ormond Beach, Florida. Now, that's not her real name, right? When you send me your questions, I change your name to preserve your privacy unless you tell me otherwise. Anyhow, Janet's question is as follows. When I turn 71 and a half, how much do I need to take from my IRA, and does the rule apply to all of my accounts? I love questions like this because many people have the same question and may not be sure how or whom to ask. Let's start with, what are required minimum distributions? RMDs, as they are often called, are the distributions you must take annually from your IRA, 401ks, 403bs, 457s, and other qualified retirement accounts. In general, qualified accounts are your employer-based retirement plans that either you or your employer has contributed pre-tax money into while you're employed. Individual retirement accounts, IRAs, are often referred to as qualified accounts as well. These types of accounts qualify for special tax treatment under our tax code, so they are called qualified accounts. Under current tax law, your first RMD must be taken by April 1st of the year following the year you turn 70 and a half. Got that? I know that's a mouthful, and it's weird. Rewind and play that back a few times. Such a scheme could only have come from Congress and the IRS. Anyhow, the unusual date is probably the result of some budget negotiation or because a senator didn't want to start taking his or her RMD for a few more months. I hope it was worth it because it's certainly confusing for a lot of people. Here's an example to illustrate how you'll need to calculate your first year RMD. Step 1, know when you're going to turn 70 and a half. Let's assume you turn 70 on June 1st of 2017. That would mean your first RMD would be for the same year because you turned 70 and a half before the end of 2017. Step 2, we need to know the previous year balance of your qualified accounts. Let's keep this simple and assume you have only one IRA worth exactly $100,000 at the end of 2016. Step 3, you'll need to look up your required withdrawal factor. There's an IRS table for that, but it will probably be easier just to use an online RMD calculator. FINRA, the Financial Industry Regulatory Authority, for example, has one that's easy to use. Just do an internet search for FINRA RMD calculator. Step 4, do the math. Use the table or the calculator and follow my 4-step process. Doing that, the RMD is $3,649.64 for someone who has an IRA of $100,000 and who turned 70 and a half before the end of 2017. Easy, right? RMDs are required by the end of each calendar year once you are in your 70s. But with the thanks of that senator, the first year is a little more flexible. If you do want to wait, you can delay taking your first RMD until that April 1st date of the following year. Of course, if you put off your first RMD, you'll be required to take a second RMD in the same tax year, which could have adverse tax consequences. RMDs are required each year until you fully deplete the applicable accounts. Remember, the whole point of RMDs is to force you to take money out of your account that hasn't been subject to taxation so you can pay tax on it. Why? You know the answer. It's all about tax revenue. We need about $4 trillion a year to run our government. One more thing on RMD calculations before we move on. Just for fun, the percentage you are required to take out goes up each year. The first year's percentage is about 3.8%, then it increases each year thereafter, 3.9 at 71, 4% at 72, 4.6% at 75, 5.7% at age 80. As we get older, the percentage continues to rise with 7.3 at age 85, 9.6% at 90, 13.2% at age 95, and 18.9% by the time you reach age 100. Of course, these calculations need to be done each year using the value of your accounts at that time. Yay! Okay, let's summarize. RMDs start at 70 and a half. RMDs apply to all qualified accounts, and the percentage you have to take out each year goes up. The good news here is when you are clear on how RMDs work, you can incorporate them into your overall retirement income plan. Thanks again, Janet, for a very good question. Okay, just in case you haven't gotten your fill of RMDs and taxes, let me share a couple more things with you before you go. As a CPA, I get tax questions fairly often about Roth IRAs, inherited IRAs, and deferred annuities, and including questions about how RMDs apply to them. Let me dispense with the Roth question first. One of the key features of a Roth IRA is that there are no RMDs. Why is that? First, it's a perk. It's a perk to encourage you to save for yourself. The second reason there's no RMDs is because you've already paid income tax on your Roth, which, by the way, is also a perk for the government because you have to pay income taxes when you convert your regular IRA into a Roth IRA. The big upside with Roth IRAs is that you don't have to pay tax on any future gains as long as you follow the rules. Next up are inherited IRAs. They do have RMD requirements. Just as it is for IRA owners over the age of 70 and a half, a percentage must be withdrawn each year from an inherited IRA. The amount will depend on several factors, including the age reached by the original IRA owner at death and the age of the beneficiary who has received the IRA. Now for the annuity. There are no RMD requirements for non-IRA, non-qualified annuities. If it's not an IRA, there's not an RMD requirement for an annuity. However, tax-deferred annuities are treated differently than retirement accounts under current tax law. Money invested in any of the three primary types of deferred annuities, fixed annuity, index annuity, or variable annuity, can grow tax-deferred until you take money out. That's why they're called tax-deferred annuities. By the way, you can either put IRA or regular money into an annuity. A lot of people put their IRAs into annuities. Over $100 billion of IRA money goes into annuities each year. Regardless of how you invest your IRA money, the tax treatment's the same. A CD, mutual fund, stock, an annuity are all treated exactly the same way tax-wise when owned by an IRA. Whatever you buy with your IRA money doesn't change how the IRA or the withdrawals are taxed when you take the money out. Putting your IRA funds into an annuity doesn't change it from being an IRA. Your IRA now owns the annuity. The tax treatment will be different, however, for a CD, a mutual fund, a stock, and an annuity when you are using after-tax regular money to buy these assets. Okay, that's enough on IRAs, annuities, and RMDs, don't you think? Thank you for joining me. I hope you've enjoyed the program, and I hope I've helped you plan stronger. See you next time.
If you would like more information about the topics and our guests featured in this series, please visit our website at PlanStrongerTV.com. Also, if you have a question you would like David to answer, please send it to questions@PlanStrongerTV.com.